Hello, everyone. Welcome back. It's time for another episode of the Ramos Law Difference Makers podcast. And I'm your host, Dr. Jim Hoven. And today I have a chance to meet with someone who is all about the numbers, all about the business, but is running a really cool life in the meantime. I'm going to share our guest's name with you in a moment, but I want you to prepare as we go into this conversation that even if you don't own a small business, you might know someone who does. You might be thinking that you might want to get into a small business, or you might want to know about protecting your business from identity theft or fraud or these kinds of things. We're going to talk about all that stuff today. My guest is Steve Hovland, and Steve has a company called the Hoveland. I want to make sure I get it right. Hoveland Forensic and Financial. That is what he's all about. We're going to have him share his story today. So first, Steve, welcome to the show.
Thank you, James. Thank you for having me, and I'm excited to be here.
Absolutely, man. I know that we are new friends. We have opened our facility, our office firm up in Grand Junction where you live. It's a beautiful part of Colorado. Have you been in Grand Junction for a long time? Tell us about how you get to this beautiful paradise.
Well, I'm one of the natives in this area. I was actually born and raised. Grand Junction is in what's called the Grand Valley. You know, it's a fairly large valley that is more oblong. It's kind of stretched. It's not a kind of a round valley. And I actually grew up in a town called Mac, which is, if you're driving through Colorado into Utah, it's the last, and I'll use the term loosely, town you go through to get into Utah. And so I was born and raised there. I grew up on a farm out in Mac. You know, we had over 160 acres of land and a bunch of horses and other type animals. And from that aspect of my life, my dad was a carpenter, and he actually used to teach carpentry. And so he built the family house. He built our barn, which was I think it was 80 or 40 feet wide by 100 feet long by about 80 feet tall. So
Wow.
it was a big barn. And he did it all with a hammer and a skill saw and all that type situation. No nail guns or anything. So he was the type of person who he could just, because he was born during the Depression. So he was that type of person. He could see something, build it instantly, cut it perfectly. I unfortunately did not inherit that skill. I could not cut straight to save my life, or cut on the mark. And so I realized I needed another career because carpentry was...
Let me jump back. I got a question.
Sure.
So you guys have this big acreage, all these horses, all these things going on, but he wasn't like a rancher farmer. How did he manage all that?
Well, there was four of us, four kids, and him and my mom, and so, you know, we kind of, it was a team effort to manage it. We had a lot of pigs too, and so yeah, we built up this farm, and you know, and he grew up somewhat on a farm out in Minnesota. So, you know, my last name's Hovland, and so it's Norwegian, and so I have a lot of relatives up in the Minnesota area. And so he came down to Colorado, and, you know, that's where we were raised. And but kind of long story short, I realized I couldn't cut straight. I was horrible at working with it. I mean, I love it, but I just can't do it very well. And so I realized I needed another profession. And I was good at math. You know, obviously growing up with a dad who's a carpenter, you're around a lot of math figures all the time. And so I kind of migrated into college. In college, I migrated into accounting. I went to what's called Colorado Mesa University, which is the major college here in Grand Junction.
Cool place, by the way. My daughter went there and did an amazing exchange program through Europe from her time there. So I'm a big fan of that school. Great place.
Yeah, it's grown significantly since I graduated. So I graduated in May of '99 with a degree in accounting. From there, I ended up going into public accounting, you know, and outside of living in Fort Collins for a couple of years and Montrose for a little over a year, I've pretty much been in Grand Junction all my life.
Wow. And so then you go into public accounting, and at that time, were you in a big accounting firm, or were you doing mom and pop, like just regular people like me? Were you doing corporate stuff in the public accounting sector? Where did that go? Where did your path take you?
So the firm I went to, there are almost 100 employees. You know, they had offices kind of throughout the Western Slope area. And so when I worked for them, at first I did tax. Because when you go into public accounting, there's two distinctions. There's either do tax returns or you do audits. I initially started doing the tax work. I was good at it, but I didn't really like it that much. And so I migrated over to the audit world. And that's where kind of my passion with financials kind of took off. And also my passion for internal controls. Because when you're an auditor for a CPA firm, one of the actual requirements that you have to have is when you're auditing a company, you need to have an understanding of their internal controls. Not only understanding, but you also have to be able to identify any weaknesses in their internal controls. So I used to just love that.
Can you define those for us, Steve? What the internal controls are, in case someone is not familiar with those kind of situations?
Sure. The main thing that most people are familiar with on internal controls, it's called segregation of duties. And it's kind of a buzzword, but it's really the foundation for internal controls. So in a kind of a nutshell, internal controls are how you control the flow of money in and out of your accounting books, how you control the flow of physical money like cash in and out of either the safe or the deposits or into the bank, how you control the assets within the company, i.e. physical assets like a laptop, or if you have precious metals, those type assets. So it's really controlling the assets and the income and the expenses of a company. And with segregation of duties, that's kind of like the big cornerstone of all internal controls. Is, a lot of times when you see a fraud happen, in the news, usually it's because somebody had access to multiple areas in the internal control, and so they could override those controls. But in kind of a layman's term, internal controls is just making sure you have control over all the inflow and outflow of your money within your company.
And does that hold true in personal finances as well? Is there something, if someone's not in a business that's watching or listening to this anywhere on planet Earth, could they take a parallel and say, man, I have internal controls in my own finances. What money am I putting in? What money is going out? And not obviously the segregation of duties part is probably a little bit different, but as far as the internal controls, would there be something that you would share that you might give as a tip for people in their personal finances in that way?
Yeah, it's a lot of times with a personal finance, and I use this example sometimes with, I belong to a organization here. It's called the Business Incubator, and it helps small companies that are just now starting out, and it goes through and gives them the step-by-step process on the how to do accounting, how to market your products, so on and so forth. And I usually come in and give them a speech on internal controls. And one of the examples that I give them is I'll take the credit cards out of my wallet and I'll put them down on the desk in front of me as I'm talking. And I said, right here, with all these credit cards, there's probably $30,000-$40,000 of credit, available. It was like, as a person out here, would you stand up and walk away and leave your credit card sitting there, type situation? And of course they all say no. And I said that's kind of the point to drive home, is from a business standpoint and also from a personal standpoint, is you protect your respective assets, and always have that mindset. Would I take the money out of my wallet and put it right here type situation? Or if you think kind of like a online scam, where they're saying, I'm a wealthy prince in such and such country, please send me this money and I'll send you all this money back. I always equate it to a actual commercial I saw once, where online people tend to want to trust that person that's emailing them. I said, but if you had an individual standing in front of you that made your hair rise up, would you hand them money? No, you probably wouldn't. So it's the same concept. And so that's what I kind of tell the people is, online, when you're getting something or a solicitation, always the keyword of trust but verify type situation. I know I personally, when I have something like that come up, I will usually independently look them up to see, is this legitimate? Is this something to think about? And then kind of look in the background to see, what is up, because there's always, I tend to think, is there an ulterior motive here for this particular individual? So
that makes sense. And it's with that keen eye that you had just shared with us that you now go into this audit position that comes into forensics. Can you describe, number one, how did you make that evolution? And maybe it's just a natural fit where auditing turns into forensics, where now you're looking not for just numbers, you're looking to see if there's embezzlement, fraud, or maybe that there's not, right? Like, how did that transition happen in your career?
Like I said, when I started to do the internal controls, so when it kind of a step back, when you get into public accounting as a staff accountant, we all know this, if you're in a professional field, when you first get in, you get to do a lot of the grunt work. I mean, that's just the nature of any professional field. And so part of the grunt work is, documenting the internal controls, like, the cash receipt process for company XYZ. I would have to go through, type up a memo, get it all, set up, give it to the partner would review, and all of a sudden give me all these other questions to ask. And just kind of through that repetition of doing that constantly, for the cash receipts, cash disbursements, so on and so forth, is I just became better and better at identifying internal control weaknesses. And so then that eventually led to doing forensic investigations. And the difference between a financial audit and a forensic investigation, now there's many, but kind of the bigger ones, is on an audit, you're just looking at to make sure that the balances on the balance sheet are materially correct. Not exactly correct, but they're pretty close. On a forensic investigation, you're going and investigating every single check or every single invoice and saying, is this proper? Who did this go to? Type situation. So they're definitely unique split there. And what I enjoy about the forensic side is it's like a puzzle. And so it's, so if somebody did, quote, take money, it's my job to figure out how they did it. And every single time, the first step is I want to know what the internal controls are, because that's going to be the roadmap to tell me where the weakness is. If you have 4 separate people overseeing the cash receipt process, well, there's probably not going to be fraud there unless you had collusion between 2 or 3 of the people. But on the disbursement side, the check's going out. If there's only one person there, that's where I'm going to focus my attention. And then from there, I'll start breaking it down into the minutia. But the forensic side it's kind of like like I said, it's a puzzle. And it's, we all have like that game on your phone that you always want to play. I'm always playing Spider Solitaire. It's just one of those games that just, I know it's a super old game, but it's just so fascinating because it's literally every single one is a different puzzle. So
that's amazing. Have you ever seen the show American Greed? Have you ever seen that show? It's on cable.
I don't think I have.
It's interesting because every episode, and I've seen it a good number of times, but every episode is about someone who gets an idea and it ends up going, either it was hatched with fraud or getting over on someone in mind, or it started out innocently enough and then something happened and it goes sideways. But the people always get caught in the end. And one of the things that comes up again and again on the show is this forensic accounting business that you have just started alluding to. Do you have any stories that you could share of like an interesting situation that was like, man, you wouldn't believe what, like it was this and it found out? Because the stories to me are fascinating, and we should learn from these mistakes as quality business owners or people in communities working for companies, right? Like looking for things. But do you have any that really stick out in your mind as, wow, this was crazy?
I've had a couple of them. One of them I can't opine on, but I can talk another one. A lot of small businesses use QuickBooks. And QuickBooks is actually a very good program. It gets a lot of knocks from people. It's not a program you would use for like a $10 billion company, but for a small, medium-sized business is actually very competent software. What a lot of business owners don't realize is in QuickBooks, there's a feature called the audit trail. And so, if you ever have a concern about anything happening within the books, you can always go into the audit trail and then start, filtering down for specific items you want to look for, either checks that were changed, or, a check amount that was changed, or something that got deleted. That is like a huge gold mine. So like when I do a forensic audit, and if the particular case involved QuickBooks, that's literally one of the first steps I go to is I go to the audit trail. It's like, okay, I want to see what's been changed and modified. The other aspect is in QuickBooks, when you bring up a report, say like you go into the cash and you see all the transaction in the cash, there's a feature in there where you can set one of the filters that say, I want to know when each transaction was last modified and who modified it. And so then that instantly brings that up. And so using those features, it allows you to kind of get a picture of what happened in the background, because the financials you get is just what they want to show you. It's, as a forensic auditor, I want to know what's happening in the background, if there is anything happening in the background. And in one situation, when I was doing the investigation, the records of the other side was hesitant to give me the accounting records, obviously. But when they finally did, they quote said, well, these records are only from this date to this date. And I went into the accounting records, and I was actually able to see all the transactions that they deleted prior to sending me the information, because it literally says it'll put it in bold. It'll say this transaction was deleted, and you go through. And some of them were just legitimate transactions that probably should have been cleaned up a while ago. So that not all of them are suspicious, but there was one that I don't know if they were just joking at the time they put the transaction in. They had done the transaction like 3 or 4 years ago, and then they deleted it before they sent it to me. But it looked really bad because in the description they literally wrote "hide money." I was like, that was literally I'd never seen that before. And so I did a screenshot and sent it to the attorney, and he was just shaking his head. He's like, I can't believe that. I was like, yeah, they had a transaction, they posted, like I said, they could have been joking when they put it in 3 years ago, but now that they deleted it and then I see it, it's like, well, I've got to report this.
Investigate that one.
But another tidbit I will give to the small, medium businesses, and this is a weakness a lot of businesses have, is if you have QuickBooks, you've got to have username for each person that's in there. Unfortunately, a lot of businesses just say, oh, just use the admin one. Well, when you have that case, when you have multiple people using that login, when you go to say who made a transaction, it just says admin, admin, admin. It's like, no, if Julie is my bookkeeper, well, Julie should have a login that has her name so that when she makes transactions, who she did it. And then if John has one, he has a separate one. So that's a big key, is make sure each person has their own individual login. And also just from a theft standpoint, from online hacking, get rid of the admin name, change it to administrator 123 or something, because most hackers know that people won't change that admin name. So they already have half the equation. They know what the username is, and they just have to hack the password. So that's another thing, is change that name to something else and get rid of just admin, because they know half the time people don't change that name.
That's great advice. When you're looking at a business, when is it that they would ask you, because you do a few things, we're going to talk about all of them, but when would they ask you to look at the forensics or forensic accounting of their business? Is there something that creates that kind of a need in a company where they call you for that, as opposed to some sort of just regular accounting procedure?
Usually it happens because cash has gone short. Or the bookkeeper who'd been there for 20 years, a trusted bookkeeper, and all of a sudden they left. And now they realized everything wasn't reconciled. Accounts weren't, they have accounts receivable that aren't being collected on. They have bills that haven't been paid. That's usually when I come in. Some sort of event has usually happened, and then I come in. Occasionally it'll be because there's multiple partners and they're fighting with each other, and so they want me to come in and look at everything, because they don't trust, the partners don't trust each other, type situation. And so I'll come in and look at that, but usually it's some sort of event has happened, and so then I need to come in and look at that. Or conversely, they'll have me, if the books were actually not properly kept, they're kind of haphazard, and they're finding all these transactions that aren't in there, they get concerned, and so they'll hire me to come in and more or less recreate their books, and then say, okay, this is really where you're sitting at as of right now, type situation.
I see. And so if a couple scenarios, tell me how this would work. One, let's say the trusted accountant of 20 years ends up leaving, and when he or she leaves behind, the people come in and start looking at stuff. If there was improprieties there, is there a statute of limitations of whether they found, we'll call worst case scenario of of stealing. So they didn't make mistakes. They took money. Is there a statute where they're like, oh, this happened blank years ago, this account, it was never caught, so it's never there? Or can that person be held liable for the errors of commission that they made? Is that something that they can go back to?
That usually depends on the attorney, because that gets into the law aspect. My part is I just go through and investigate to find out what is missing and how much is missing, type situation. A key point to bring up is when I'm brought in, sometimes the records aren't available, the historical records aren't available. I can only investigate what records are there. So if there's records missing, I can't necessarily investigate it to bring it into the report. But from a statute of limitations, that usually is set by either respective state law or what the attorneys want to do. And then, of course, that's the decision. At that point in time, do they want to press criminal charges or do they want to go civil? It's been my experience, unfortunately, and you see this a lot, when a company discovers fraud, that they won't press criminal charges. And the reason why I say that's unfortunate is because that let's say, John Doe committed fraud, they may say, okay, you owe us this money, pay it back, but they don't do criminal charges. Well, then John Doe goes to the next company, and because of HR rules, you can't disclose that because there wasn't a criminal case done. And I've seen it in the media, and I've seen it personally, where then that person then commits fraud again to the next company, and so it's that bad apple that just keeps getting pushed down the road. And usually the reason why the companies don't press charges, they don't want it out in the public. They don't want the public to know, hey, John Doe stole money from us type something. It's more of a trying to keep up appearances type situation. Yeah, exactly.
Yeah. What if partners are selling a business? Is that a time for forensic counting to make sure that the business is what it is supposed to be for the buyer and for the sellers, or is that a different kind of accounting process that would go into play?
It's kind of in that realm. So a lot of times you'll see forensic accountants who are also business valuation specialists. I'm currently not one, but those processes kind of go hand in hand. Because as a business valuation specialist, you need to make sure the numbers you're looking at are correct. Because if you're using those numbers to do your formulas and those numbers aren't correct, then the whole valuation is wrong, type situation. So I have done a situation where I've worked hand in hand with the business valuation individual. So we do have that process, but the overall value of the business usually will center on that business valuation person, because that is a very litigious occupation, because you got two partners, they're never going to agree on, well, this person said the value is $1 million, and then they have their other business valuation says $2 million, and then they sue each other, and then they sue the business valuation. So that's one of the reasons why I don't get into that area, because it's just nobody's ever right.
Yeah, no one wins.
And the funny thing is so when I sometimes talk to accountants that are in college, or first, second year staff accountants, they find out I do forensic accounting, they get super excited. Oh, I want to do that. And I always have to tell them, you have to understand, when you take on a case, at the end, one person's going to be mad at you. Either the plaintiff or the defendant. Somebody's always going to be mad at you. So you got to understand, you have to have thick skin on that.
Yes. That's an important point that I never even thought of, but you also have this other side that you do on the accounting side, which is the small business, like getting development. You have two parts to it. One is this, helping businesses understand what are the key financial tools that you need to have, what are the key reports you need to look at, how do you interpret these various documents and that kind of thing. And then this fractional CFO, I want to get into both of those things, because I think they really lend very well and blend together very well. Tell us about, for small business, when you're working with a small business, what do you go in and tell those folks when they say, man, see, we need your help to make sure we're successful?
So when I take on a new virtual CFO or fractional CFO client, literally the first question that I ask them is, let me see your budget from last year. And I'll tell you, probably 99% of the time, they don't have one. And so, and that's kind of the big thing with my virtual CFO, fractional CFO side, is helping the clients understand kind of the financial, the CFO side of their business.
Describe, if you would, for some people, because people think of CFO as a C-suite position, C being CFO, CEO, COO,
right.
et cetera, et cetera.
Mm-hmm.
A lot of small businesses, like you said, they don't have a budget, but they also don't have a C-suite. They have,
Mm-hmm.
Me doing, head bottle washer and janitor and cook,
Mm-hmm.
and as they describe it. Talk about what a certified or a corporate financial officer is supposed to do in a company, so that people get a background of that, because you're going to then take that and go, holy cow, you mean a small business can have that kind of professional and be able to afford it? So can you describe what a CFO does?
Sure. Yeah, a chief financial officer is kind of the head financial person of an organization. They will look at not only the results that are happening now for the company, how many widgets are they selling? They'll look at what is the cash flow projection for this next year, for these next 13 weeks? How much revenue do we need to bring in by end of the year to hit our goal of, say, $10 million net revenue? How much revenue do we need to bring in to hit a net income of $1 million? If we're taking on a new product, is that product profitable? Should we be focusing on that product versus another product? Are there any constraints in the production? If you're a manufacturing and you got product A and product B, but they all both take up the entire floor of the manufacturing facility, which one should you focus on? What direction do you want the company to go in? So it's not just looking at a budget, but 3-4 years from now, if you're a small company, do you want to sell the company, 3 to 5 years down the road, or do you want to turn it over to your family at that point in time? And so we go through that and we start building out the process, because we're going to map everything out so that if we do get off track, we know where we need to pivot to get back on the track. And so, like I said, the very first part is just developing a budget. And unfortunately, a lot of colleges out there, and even high schools, they don't teach business owners how to properly do a budget, and not just, budgeting, I'm going to buy this amount, 5 tons of steel, today to bring it in to do the manufacturing, but what where do you want to get to at the end of the respective year? And so that's one of the bigger things we do, is we build that budget for them, and then from there we look at it every month, and looking at every month is kind of the forecast. And the way I explain it to kind of the small business is, the budget is kind of where you want to wind up at the end of the year. So think of it as a map. So we're in Colorado. If I want to go to Las Vegas, so Las Vegas is kind of my destination. So assume that's my budget, and how I get to Las Vegas would be the forecast. So at the end of the trip, I'm going to be at Las Vegas, but just for geographical reasons, I have to go down I-70, then not down I-15. Well, let's say part of I-70 is closed. Well, that's no different than like your business. All of a sudden you have a big interruption, i.e. you have the pandemic hit, or all the employees are now sick for some reason, or a product that you need to send out, you can't get the raw materials for the next 3 weeks or 4 weeks. How do we pivot around that to still get to that end destination, in this case, Las Vegas? So, if there's a detour on I-70, okay, I may just go down, one of the highways down to Moab and cut across, and then I'm back on the interstate, and then bang, I'm back on my destination. And so that's what I work with each of my small businesses. I say, okay, here's our budget. Let's say, we end of March, here's the budget. We're on track for, our end destination of, say, $10 million. But let's say April, we have something happen and say, okay, here's how we need to make this up, type situation to get to that point. Otherwise, we're only going to hit, say, 9 million versus 10 million. And then here's the impact. And then also with that, we also build in, how much cash are you bringing in? One thing that some of the small businesses don't realize is, when you have rapid expansion, you're bringing in new and more clients, it's actually a cash flow hindrance if you're doing receivables, because you have all these sales and all the inventory that you have to pay to send out, but then you're not collecting the cash until later down the road. And so we kind of help them with that little cash gap that may happen. So it's all the aspect of taking the debits and credits and then building on top of them to make them work for the respective business owner.
That's a really great description. And Steve, I got to ask this question based on that. In a small business, and maybe it's industry specific, do you like to see, for the health of that company, a minimum profit built in? In other words, you should operate at 60% overhead and 40% profit. And I know we're talking about net and gross profit and these kinds of things, but is there something that you as a CFO would look to be able to tell a small business, or really is it industry dependent, where if you're selling widgets versus you're doing a service, maybe the overhead requirements are way different in that, or an online business versus a brick and mortar business? Is there anything that you can share with business owners or those interested in business on where you should look to keep your profits beside as high as profitable or as high as possible?
Yeah, the first step I always do is I look at the industry guidance. Because like you said, if I have one client that sells widgets and the gross margin is 25%, and then I've got another company that's a service, but they get 40% gross margin, I can't use the 40% on the 20% because he'll go out of business trying to charge that much. And so first I look at the industry, and then I look at what the client is currently doing. And a lot of times I use that to determine efficiencies. If they are, let's say the industry standard is 25% and they're sitting at, let's say 15%. I was like, okay, we need to figure out why the industry is, producing so much more than you guys. And a lot of times it's an efficiency standard. They're not building enough widgets per hour to be able to get to that 25%. So their labor costs become almost fixed versus variable in that situation. So we look at all those metrics to decide, okay, how can we get to there? And we then build kind of what the buzzword in the industry is the financial levers. What levers can we pull to get to that spot? Do we need to, if we bring in more employees or more workers into the warehouse, how much more can they produce? Or how can we track to see, what workers are actually producing what we want them to? And this kind of actually dovetails into when we build a budget for our clients, we do both a top down and a bottom up. So the top down is kind of the higher level. Hey, I want to make $10 million revenue at the end of the year. So we sit down and say, okay, that's our goal. So each month, do you have any seasonalities? And we start breaking out those aspects. Then from there, we'll then break it down to the minutia. And this is what I call the bottom up. We start saying, okay, how many products do you have to sell to get to, let's say April, we're going to sell $1 million. Okay, how many products do we have to sell to get to that million? And do you have the capacity to hit that? So it's not just saying, here's this magical goal at the end of the year. It's, okay, that's the goal. So how many products do we have to sell? Do we have enough inventory on hand? And do we have enough labor? But it all wraps up into looking at the industry standard, because a lot of times the industry standard will be a blend of everyone. It's not just like one or two companies. And so if they're producing better on one aspect than you are, then it's like we want to look at most of the time it's an efficiency issue. Why is that industry more efficient than you guys, and what can we do to mirror that aspect? The one thing I do kind of across the board for my clients is I recommend they keep a cash reserve, and this is more the balance sheet side, a cash reserve of 10% of the 12-month rolling average of your revenue. And again, that's kind of the piggy bank. Normally you do 10 to 20%, but getting up to 20% is kind of hard for pretty much any business. So I say at least have 10% sitting there. That's kind of the, hey, I need to get this material in. It's got to come across the ocean on a ship. If I expedite it, I can get it here now. If I don't, it's going to be 4 weeks. I need to, obviously you're going to have to pay more to expedite it. Hey, I got this reserve I can use. Or, hey, I'm expanding. I'm going to bring in this new product. I understand that the collections aren't going to happen right away, so I'll utilize this reserve to there. Having that reserve allows you flexibility to maneuver, and gives you room to make a mistake if something were to happen. So,
Steve, is that 10% of the the cost of running the business per month, or is it 10% of the cash collected per month? When you talk about that 10%, can you just give me a little more clarity on the 10% of what number?
Sure. It's the 12-month rolling average of your revenue. So But
Got
for
it.
simplicity, let's say you had 10 million at the end of the year, 12 months, you take that 10%. So you should have $1 million approximately sitting in your reserve. And that's where that focuses on, because that gives you the wiggle room. If you have, a bunch of, especially if you have a concentration on your clients where you have, accounts receivable, but, let's say you have 500,000 accounts receivable, but 450 of it is with one customer, and that customer is not paying right away. That gives you that flexibility to be able to keep the business running, type situation.
Yes. Now, what about this? There's always the question of volume versus value. In other words, you have the Walmarts of the world that are pushing to sell at the lowest price and sell lots of it. And then you've got the boutique that says, we're going to sell far less, or we're going to move less product, but we're going to have more value to each product. From your perspective, is there a quote unquote more right way? Does it depend on the person's personality, their risk tolerance? What describes whether someone should, because there can only be one lowest price, right? So
right.
Should more businesses focus on volume, value, or again, is it industry dependent?
It's usually one industry dependent and also capacity dependent. What you run into is when you start doing the Walmart aspect is you have to have a large capacity to be able to produce those. So, if you're selling let's say a mini widget and your gross margin on that is $1 and you need to get to $10 million at the end of the year, well, obviously you've got to sell 10 million of those units just to hit that margin. Whereas on the boutique side, you're probably going to be selling it for more, and you're also probably going to have a larger gross margin on it. But the danger when you get into the volume is you have to make sure you're doing what's called the free cash flow. The cash that you're receiving back is greater than the cash that went out. Because I have seen situations, and this was during my audit career, where the product itself was losing money, but the owners just thought, well, if we produce more of it, well, if individually it's losing money, producing more is not going to magically make money. So it really boils down to, if you're doing the volume aspect, that product has to be making money. It has to be covering your break even and then contributing to the bottom line, the net income.
And do you calculate the cost? So let's now switch to a service industry. For example, in my previous life, I had chiropractic clinics, and so we would have patients. We would calculate what is the cost to treat a patient, and we would have to use the overhead for, and I don't know if we did it right, but we were thinking, okay, well, we have this many team members, we have this much in rent, we got this much in supplies, yada, yada, yada. So if I take that and say what my price per chiropractic treatment was, if I treated below that price, then it was kind of like what you were saying, is like, well, man, we're losing money to treat. Now, the problem that a lot of doctors will run into, and maybe business owners of all types, is if I say, well, if I've got extra space in my schedule that's not full, is some dollar better than no dollar? Now, at capacity, this whole concept changes for sure. But if I got 30% availability in appointment times, or if I have food in my restaurant that's going to go bad if I don't sell it by the expiration date, is getting some money better than no money? So can you just kind of speak to that whole thing a little bit? Because I know a lot of small business owners say, well, man, I need to just kind of keep things going, keep some cash coming in, but they might be cutting themselves up by that last concept of selling it for less than it cost you.
Right. Yeah. I might take the last part of that first. If you, like the example you gave with the restaurant, obviously that food's going to go bad. So that is, yes, let's cut the cost, get some cash back, because otherwise you're just going to dispose of it, and you're going to eat all that cash, right? Or cash outflow. So yes, I am 100% agree on that. That's in the accounting world, that they call that the impairment on the inventory. If inventory is obsolete or impaired, getting something versus just scrapping it type situation, I am 100% agree with that, because get the cash in if you can. But from a standpoint, kind of a services standpoint, what normally you see is, and this is kind of, back in my public accounting days, is you do exactly what you said. You go through and you find out all your costs, and what's your overhead, what's your fixed costs, so on and so forth, and that will determine kind of what you need to cover per person per hour. And then from there, you say, okay, then what's my billing rate? And so that's really what some people don't realize is a lot of like accounting firms, attorney firms, or those type of professional organizations, is their billing rate is usually based off of all the costs that they have to cover plus 30% or 35 or 40%. The percentage varies. And that's how they determine their billing rate. It's not just some arbitrary number that they came up with. They actually back into it. So then from there, they then determine, okay, here's my billing rate. Let's say it's $200 an hour. And they say, okay, if I can have 1,800 billable hours, $200 times 1,800 billable hours for the years, I'll get X amount in total revenue per person. And then for all the people you have in there, you'll then multiply that out. Then what you need to do is you need to determine how much is realizable. So, if you have, you're working with a customer and you say, okay, this should take an hour, but it took you 2 hours. A lot of times, you probably can't bill that extra hour to the customer. So you have to, quote, eat it. And so you have a realize, in this case of 50% versus 100% if you had done it in a full hour. So you need to be able to determine what's my realization per hour, per person, per customer. And so that all gets built into your budgets. And so that will help you cover your costs in there, because we've heard the term, somebody was just buying work. They bid low on a job just to get the job. That's fine if you're in a seasonality business where, let's say in the summer you have literally nothing going on. So, hey, at least some cash coming in is better than none. But it also will start eating away at your profits, because yes, you're getting cash in, but you're losing that opportunity to bring in, the better realization type customer. So it's kind of a sword edge there. Is if it isn't a time where seasonality, where you literally have nothing coming through the door type situation, yeah, you might bid on some work to bring some cash in, to at least, cover some of your cash costs. But you have to understand you're still losing money at that point in time. Yes, you're hedging some of the cash flow or stopping some of the cash bleeding, but you're also hindering yourself from bringing in a better opportunity. So again, it's kind of the devil's in the details as to when it's happening and what you're willing to accept.
Yes, so good. This is so good. I hope that anyone watching this, again, you can appreciate what goes on in a business. If you work for somebody, the person that you're working for, the company, they have to think about all this stuff. Mm-hmm. But if you own a business or if you know someone, again, share this information. This is absolute gold, that if you're not doing it, you need to do it. And if you are doing it, just a reminder of how important it is. So, a couple more questions for you, Steve. This has been just so great. Mm-hmm. What should businesses, let me rephrase it. How does a business know what their KPI should be? Maybe there's some universal key performance indicators or key metrics, as you referred to it earlier in the show. Obviously, you got to look at profit. You got to look at, overhead. You got to look at some very critical baseline things across the board. And then they become industry specific as well. But is there a way that someone could go about defining what their KPIs are? Could you give any guidelines to that effect?
Sure. You'll see kind of the generic ones of, how much cash do I have in the bank? How many days cash flow or days cash do I have on hand? But the ones that are the most important for a company are the non-financial metrics. So if, kind of like that volume situation that we just talked about, if we know that, that widget that we're grossing $1 on per widget, it is profitable. Okay. How many widgets do I need to make in a day to get to that point? So that may be one of your KPIs is, okay, I know I have to crank out 1,000 widgets per day. And so you can use that as a KPI. It's like, okay, we only hit 900. So that means tomorrow we need to get up to 1,200 to compensate for, that 1,000 that we didn't get done today to get us back on track. And so those type KPIs it's really focused on getting the, how much product do you have to build? How many employees per product do you need? What is the on-time delivery? That's a non-financial metric. If you have customers that are saying, hey, we're ordering these products from you, we expect delivery in 6 weeks, a KPI can be saying, okay, did we hit that? Did we get to that point? Or did we deliver it, 7 weeks? If we did it 7 weeks, we either one need to look at our efficiencies, or two, we just didn't quote it correctly to the customer. We gave them bad lead times on there. So it's those items that all build up to getting to that end goal of, say, the 10 million in revenue, is all the different little aspects in there as to how to build that into it. So it's really mainly focused on how do we get to that goal. How do we get to that? If 10 million is your goal, how do you get to there? And so you break it down to the most finite items. It can even be as finite as making sure you're ordering the inventory timely to get it in the door. And I want it in the door by the first of every month. And if I have to order it, if I live in California and it's in New York, I know that transportation time takes a while. So, am I meeting that goal? So the last thing you want to do is have all your employees show up and they're standing around because they have no work. Well, you still got to pay them. And so then that just starts that will immediately eat into it. So all your KPIs really should be focused on how do I get to that end goal, plus cash flow. Cash is king. You can't operate without cash. And so make sure you have some cash flow KPIs built in as well to keep an eye on that.
That is brilliant advice. And so I have one question I want to ask you that's not related to any of this.
Okay.
And the question is this is my final question. Is there one piece of advice that you've either learned or been given along the way that you now use as it's your fundamental, one of your pillars to how you live your life, not only in business, but personal, that you'd be willing to share with us so that I could learn from it and our audience could look to take that into our lives as well?
I think the biggest thing that I came across, and this was probably about 7 years ago, was Stephen Covey's 7 Habits of Highly Effective People. I literally live that every single day. The big keys on there for small business is to make daily and weekly and monthly lists. If you get a chance, there's an old video, and I say old because you see the people and they're wearing like 1980s, 1990s outfits, where they talk about the big rocks. I won't get into it. Google that video. That is an awesome video.
Oh, good.
And so you always want to have your list. You always want to know what your big rocks are, so that you don't get overwhelmed. And another one, and it's in the 7th habit, it's called Sharpen the Saw. And if you watch the video, the concept of it is we all need to take a break sometimes. We need to get away from everything. And in the video, there's a person, sawing a tree, and, they have one of those saws with all the little teeth on there. And they're just working away, where they're not really getting a whole lot. And somebody comes up and asks him, well, why don't you take the saw out and sharpen the teeth? And then you'll be able to cut right through it. And the concept is you need to get away from your job, your work, your business, and get a refresher, because, just working harder when you're tired and exhausted, either mentally, physically, spiritually, what have you, it'll impact your work. You're getting worse returns on it. So always take a break to sharpen that saw. I'm a huge proponent. I grew up, I went through the public accounting world where, having 70-hour weeks, for 3 months at a time wasn't uncommon. And I always saw that, people just start winding down. I am a morning person. I do my best work in the morning. So I do all my hard stuff early in the morning, from about 6:30 all the way to about 11:30. And then I have my easier stuff in the afternoon, so that then I can still, get everything to flow through properly. So, but yeah, the Stephen Covey 7 Habits is probably one of the best things I've ever came across, both for my business and for me personally.
That is wonderful. So I gotta get this out there. If people want to get a hold of you to learn more about these questions, or to look at having you and your company either look at forensics for them, or learn more about fractional CFO, what does that look like, right? Like, man, I need a chief financial officer, and I could get one fractionally with that kind of expertise. How do people reach you? How do they get a hold of you, Steve?
Sure. They can reach me at hovelandforensic.com.
And let's make sure you spell your name. We'll put it in the show as well, but just because it's not exactly how it might sound.
Oh yeah, many of people have pronounced my name incorrectly. I'm used to it. So it's HOVLANDFORENSIC.com, hovelandforensic.com. You can go to the webpage. I've got 2 separate sections, one for the forensic side and one for the fractional CFO side. And on the fractional CFO, I always tell people, when they come on with us, I'm only going to charge them for things they need. I don't say you're going to get all this, whether you need it or not. We break down the services to what they truly need in there. And our fees are fixed for 1 year time frame. So there is no sudden increase. So the fees are a fixed cost to the customer. And like I said, we're fractional. So we're a fraction of the cost, but you still get the expertise that you need for your business.
That is incredible. And my friend, we could talk more and more. I've learned so much and so many things and what you've shared with me today. I'm sure our audience is the same. And so I wish you nothing but continued success. I can't wait to spend more time with you with our office opening up there. I'm going to be coming up there from time to time, visiting with our team there. And just, so I want to sit down with you knee to knee and shake hands and give you a big hug for saying thanks for this time. But man, I wish you the best and hope that you have a great rest of your day. Thanks so much for coming on the show today.
Well, thank you for having me.
My pleasure. And for those of you watching, remember, if you enjoyed it, please share it. If this is something that you need to apply to your life, don't just listen, apply, do something, take notes, and then take action. And remember, always remember, you too can make a difference.